Welcome back to Sip and Talk.
Hi, everyone. Good to be back.
You know, before we really get into it today, I can't help but think about our old friend Mickey. We talked about his big crypto loss.
Oh, I remember. He was so confident. He kept saying, stable coins can't lose money. He really thought it was like a digital savings account.
Exactly. And then his entire investment, basically his life savings, just went down in the LUNA death spiral.
Yeah.
I just remember watching the UST stablecoin drop from $1. It was genuinely terrifying. It felt like watching a washing machine stuck on the spin cycle.
Except it never spins the money back out. It just vaporizes it.
It just vaporizes it. And that's really where we're starting today. We're going to unpack that death spiral, not just as some market event, but really the technical and, I guess, the psychological breakdown.
Right. How does an algorithmic stablecoin, a system built on pure logic, on code, just instantly evaporate $40 billion when human panic gets involved?
And here's where it gets even more interesting. That whole story, it connects directly to this central, almost philosophical conflict in the crypto world.
Mm-hmm.
It's that moment when the whole community is screaming decentralization right up until a crisis hits, and then suddenly everyone's looking for the government to fly in like Superman.
The code is law ideal runs headfirst into KYC and AML regulations and realizes, oh, wait, state law is still very much in charge.
And then we wrap it all up with this, the ultimate drama connecting money, politics, and crypto, the completely bizarre NASDAQ Q listing of the Trump family's crypto company, World Liberty Financial.
WLF.
That IPO was just something else. The media called it a wedding without the bride, which immediately set off all the alarm bells.
Usually you ring a bell to celebrate. For them, it was more like a funeral toll, considering what happened right after.
Oh, absolutely. You had high-level executives missing, a $1.5 billion valuation basically built on paper, the shady Alt-5 Sigma shell company they used to sidestep due diligence, and major transparency issues that led to an 80% collapse almost immediately. So we're going to break down the technical, the financial, and the political mess that led to all of that.
So the big questions connecting these three threads are, I think, really vital for anyone trying to understand modern finance. Like, why do stablecoins crash? What makes an algorithm fail when it comes up against human fear?
And does that ideal of decentralization just naturally, inevitably collide with state regulation? And of course, why was the Trump family crypto IPO such a chaotic mess? What were the real flaws there? And what's the political impact, both short and long term?
So we're going to guide you through the technical, the institutional, and the political logic connecting all these events. Our goal is to give you, the listener, the comprehensive understanding you need to navigate this incredibly volatile intersection of code, capital, and compliance.
Let's get into it for all you sip and talkers.
Okay, so let's start with segment one, the spectacular failure of the Terra ecosystem and its stablecoin, UST. This was back in May of 2022.
And this wasn't some slow-moving crisis, right?
Mm-hmm.
It was almost instantaneous, a collapse.
Totally. And to really get your head around the $40 billion loss, you have to understand the core mechanics of the system they built. It's really key.
Absolutely. The first thing to get is that UST was fundamentally different from the big stablecoins we see today, like Tether's USDT or Circle's USDC.
Right. Those are what you call fiat-backed stablecoins.
Meaning for every digital token out there, they're supposed to have a corresponding real-world asset. A dollar, usually in cash or like U.S. Treasury bills, sit in a bank account somewhere. That's the reserve.
Which is why people trust them. It's kind of boring, it's centralized, but it's backed by actual stuff. UST, on the other hand, was an algorithmic stablecoin.
A much fancier, sexier idea.
Completely self-referential. It was all based on this complex dance between two tokens, UST, stablecoin that was supposed to be worth $1, and LUNA, its volatile supporting token.
So instead of a reserve of dollars, LUNA was designed to absorb all the price volatility of UST through this redemption mechanism.
And the entire system, the whole $40 billion house of cards, relied on one single belief: the faith that LUNA itself would always have significant value.
So it was a system built on math and human faith, not audited assets. Pure crypto ideology, really.
And the stability mechanism was supposed to be this simple, elegant arbitrage.
Right, arbitrage. For anyone who's not familiar, it's just profiting from tiny price differences between markets.
Exactly. The system was designed so that anytime UST moved even slightly away from its $1 peg, users would have a financial incentive to do something that would, in turn, push the price back to $1.
Okay, let's break that arbitrage design down because it's really the core of the genius and the core of the failure.
So let's say UST was trading above $1, say $1.01.
Okay.
Users could buy a Lunane on the open market, send $1 worth of that Lunane to the system, and burn it, destroy it, to mint one brand new UST.
And then they could immediately sell that new UST for $1.01 and pocket that 1 cent profit.
And the system loved this. Two things happened. Burning all Lunane reduced its supply, which theoretically pushes Olunane's price up, and minting more UST increased its supply, which pushes its price back down toward $1.
A self-regulating machine.
In theory. Now, conversely, if UST dropped below $1, say to 99 cents, you could buy that cheap UST on the market.
Redeem it through the system and get exactly $1 worth of LNA back.
You pocketed the penny profit, and the system benefited because you just took some UST out of circulation, which was supposed to pull its price back up to $1. I mean, on paper, it sounds beautiful, right?
Perpetual mathematical stability.
It sounds like a perpetual motion machine fueled by greed. But here's the fatal assumption. The idea that this mechanism could handle a massive, coordinated, fear-driven bank run.
When everyone tries to get out the door at the same time.
Exactly. When you're dealing with human psychology, I mean, fear is a force that code just wasn't built to handle. The self-fulfilling prophecy of belief just cast. It collapsed.
And that brings us to the ignition point, which wasn't some huge catastrophic attack at first. It was just a small tremor.
That's right. In early May 2022, a massive whale, a huge investor, sold a giant chunk of UST, and it pushed the price just slightly below the peg, maybe down to 98 cents.
Just 2 cents.
Just 2 cents. But that tiny deviation was the spark. It triggered massive panic because people started asking the question, okay, if it can break the peg by 2 cents, what's stopping it from breaking further?
And that is the exact moment the vicious cycle started. Investors see the peg break, and they all rush to use that arbitrage option.
They want to redeem their UST for Lunane to get out, to escape the sinking ship. And the system, which is obligated by its own code to maintain the peg, had to start minting Lunane at an absolutely exponential rate to meet those redemption demands.
This is the math part that's just so crucial. This is the moment where Mickey's savings and billions of dollars from other people just vanished. We have to walk through the hyperinflation math because this is what turns a stable mechanism into a self-destruct button.
Okay, think about it like this. When Lunane was flying high, let's say it was trading at $80 per token. If you redeemed 1 UST for Lunane, the system only had to mint a tiny fraction of a Lunane token.
Right, like 0.0125 Lunane. The inflation on Lunane was tiny, negligible, the market just absorbed it.
But as the pressure started mounting and Luna's price started crashing, let's say it fell to $10. Now, redeeming that same 1 UST requires the system to mint 0.1 Lunane.
So the minting rate is getting bigger as the price falls.
Exactly. Then you hit the point of no return. As Lunane crashed all the way to $1, redeeming 1 UST suddenly required minting 1 full Lunane token.
And here's the real breaking point.
When Luna plummeted even further, all the way down to a penny, or even a fraction of a penny, say, $0.00001, redeeming that same 1 UST, which the system still had to honor, required it to mint a staggering 10,000 LNA tokens.
Wow.
It's like trying to pour water into a bucket that has a giant hole in the bottom. As the water level drops, you have to pour water in exponentially faster just to keep it stable.
But the faster you pour, the more you drain your water source.
Exactly. In this case, the reserve source was Lunane's value, and the pouring was the minting. The supply of Lunane just went completely parabolic.
The result was total catastrophic dilution. The number of Lunane tokens in circulation went from hundreds of millions to multiple trillions in just a few days.
And that endless minting completely destroyed Lunane's value, dragging it down to basically zero. And because Lunane was the support mechanism for UST.
UST lost all support, dropped to just a few cents, and the estimated $40 billion market cap just poof, gone.
It was the largest single destruction of capital in crypto history up to that point.
And we really can't talk about this crash without talking about the Anchor Protocol, because this is the human side of the failure. This is where people lost their rent money, their retirement funds.
The famous, or maybe infamous, Anchor Protocol. It offered a stunning 20% annual percentage yield. an APY of 20%.
That was the ultimate bait, the honeypot that just drew everyone in.
It was an incredible high-risk lure that was dressed up to look like a low-risk savings account. I mean, at the time, traditional bank savings accounts were offering, what, 0.5%?
Maybe 3% if you found a really good high-yield account. 20% seemed like free money.
And the core question, which so many investors just fail to ask, was, where is this yield actually coming from?
Right.
And the analysis showed that the yield wasn't sustainable at all. It wasn't coming from real activity or profits. Initially, it was just subsidized by the founder's venture capital funding and a big treasury of Aluminae.
So it was a marketing expense, basically. A high-risk subsidy designed to attract users, to simulate mass adoption and utility, until the fees from the ecosystem could supposedly take over.
But the fees never caught up. They were just burning money to keep that rate high. And once that reserve started to run low, the panic set in.
And that 20% APY attracted countless retail investors, many of whom had no idea about the algorithmic backing. They poured their life savings in, thinking it was a guaranteed, safe way to earn passive income.
And when the spiral hit, their panic just compounded the disaster. When hundreds of thousands of people rushed to withdraw their money all at once, the Terra blockchain network got instantly congested.
Transactions were failing,
which just confirmed their worst fears. A lot of people were physically blocked from withdrawing their tokens, or they held on out of pure hope, believing the founders who were promising that UST would repeg to $1.
That inability to escape in that moment of crisis just accelerated the human tragedy of it all.
So if we distill this down to the core, painful, but vital investment lessons from the Aluminae collapse, what really stands out for you?
I think there are 3 huge takeaways here, and they apply to any investment, not just crypto.
Go for it.
First, understand the yield source. I mean, if something offers a 20% APY when the rest of the market is at 3 to 5%, you have to ask where that money is coming from.
Yeah.
If the source is just newly minted tokens or cash injections from VCs, you're not getting a dividend. You're getting paid by the next person to enter the system.
Analysts pointed out that in these kinds of systems, you are often the exit liquidity. It's basically a modern variation on a Ponzi scheme structure.
If the return seems too good to be true, you aren't the investor. You are the product being sold, or in this case, the liquidity being drained.
That's number 2.
The failure of that central crypto ideal, algorithm is not king. The whole code is law ideology just failed spectacularly here. Code cannot withstand extreme human fear and a bank run. The rational mathematical mechanism was completely overwhelmed by irrational human panic.
And third,
the absolute need for real diversification, or, put another way, avoiding correlation risk. So many investors held both LNA and UST thinking they were diversified.
but they were tied to the same sinking ship. A loss to one was a loss to all. True portfolio stability comes from having assets that respond differently to market stress.
Yeah. The aftermath of this crash, of course, led to massive legal fallout. What happened to the founder, Do Kwon?
Do Kwon became one of the world's most high-profile white-collar fugitives. After months on the run, he was arrested in Montenegro on fraud charges.
Right.
And as of the latest updates, he is facing this severe extradition battle between the U.S. and South Korea. Plus, the U.S. Securities and Exchange Commission, the SEC, has charged him and Terraform Labs with multi-billion-dollar fraud.
And the company itself.
Terraform Labs has filed for bankruptcy protection. It's the ultimate example of that code is law. Ideal crashing headfirst into the rule of law reality.
And the whole failure, it directly pushed global regulators, everyone from the SEC here to the European Union with their MiCA framework, to step in and demand that stablecoins be backed by real, tangible assets.
Cash, treasuries, not just complex self-referential algorithms. Aluminae showed definitively that unchecked algorithmic finance is a systemic risk that governments are now aggressively trying to tackle.
That LNA event, that moment, $40 billion just disappeared. It's the perfect transition to our next segment. It really captures the central conflict in the digital asset world.
That unavoidable battle between the utopian ideal of decentralization and the practical necessity of state regulation.
Exactly. When Do Kwon was arrested or when those billions vaporized, suddenly everybody stopped talking about permissionless finance and started asking, where's the police? Where's the government safety net?
That's the clash of laws we have to get into. Code versus the state. The crypto ideal. It's rooted in this philosophy of code is law.
The idea that the smart contract dictates what's legal. A hack or an exploit is just a technical failure, not a moral or legal one. The system just did what it was programmed to do.
But the regulators view the rule of law demands a safety net and an accountability that goes way beyond the technical specs of a contract. Financial markets need stability.
And when billions are lost, whether it's an algorithmic failure like Luna or outright fraud like FTX, there has to be legal intervention. There has to be prosecution and recovery for the victims.
The really tough part for the regulator is the accountability gap. Who do you prosecute when a decentralized autonomous organization, a DAO, collapses?
Right. A DAO is basically this entity that runs on rules encoded in a smart contract governed by token holders, not a CEO or a board.
So if a DAO's code gets exploited, do you go after the thousands of anonymous token holders who voted on some upgrade? Do you prosecute the original coders who deployed it, even if they had no control afterwards?
It's a huge legal gray zone. National laws just were not designed to handle that, and regulators are really struggling to bridge that gap.
And that gray zone is where some of the biggest battles are being fought right now. Let's look at the clash between privacy and financial oversight. Specifically, KYC/ML protocols.
KYC is Know Your Customer, AML is Anti-Money Laundering. These are the rules that make sure financial institutions verify who their clients are and watch out for sketchy transactions.
Exactly, to prevent things like money laundering or terrorist financing.
The ideal of crypto, though, is pseudo-anonymity, financial freedom, censorship resistance. We hear these great stories about people using crypto to get money out of repressive regimes or refugees avoiding capital controls.
That's the powerful, positive vision of a system that's not dependent on some central authority.
But the reality from a government's point of view is that the same anonymity is a golden ticket for organized crime, for tax evasion, for terrorist financing. We'll see this in the WLF scandal later. Governments need KYC and AML to maintain financial integrity and national security.
The flashpoint here, the moment that truly shook the code as law fundamentalists, was a Tornado Cash precedent.
Right. Tornado Cash was a mixing protocol, basically open source code designed to obscure where crypto transactions came from, to offer a layer of privacy.
And in 2022, the U.S. Treasury's Office of Foreign Assets Control, OFAC, they sanctioned the code itself.
Think about that for a second. They didn't sanction a person or a company or a specific bank account.
They sanctioned a piece of software. They made it illegal for any U.S. person to interact with it.
It set this deeply worrying precedent. If the government can sanction a piece of neutral open source code, a lot of people in the tech community argue that it infringes on coding freedom, maybe even free speech.
Plus, it created a legal nightmare for innocent people who might have used Tornado Cash for totally legitimate privacy reasons, but suddenly found their funds were tainted by these sanctions.
It showed that the state has found a way to intervene directly at the protocol level, no matter what the decentralization claims are.
And then there's the government's biggest sensitivity of all, monetary sovereignty.
Right. Luna and UST, they were trying to create a viable currency system completely independent of the U.S. Federal Reserve or any other central bank. That is a direct challenge to the state's monopoly on printing money.
And the collapse of Luna gave central banks all the ammunition they needed. It solidified this government belief that these private, unregulated currency schemes are just inherently dangerous.
We saw experts from the Chinese central bank, for example, warn that unregulated stablecoins could become a new capital flight channel, which would erode the power of their national currency.
And that fear is accelerating this global push toward heavily regulated asset-backed stablecoins, or even more centrally controlled central bank digital currencies, or CBDCs.
So the very success of crypto is forcing this collision. The paradox is that the bigger crypto gets, the more it's forced to become the very thing it set out to replace.
That's what analysts call the paradox of success. When the market cap was small, crypto was just this, technical curiosity. But when it reached a multi-trillion-dollar valuation like it did before the 2022 crash, it instantly transformed into a financial stability problem.
A problem that governments feel obligated to address. It wasn't a fringe hobby anymore. It was a systemic risk that required intervention.
And this brings us to the ultimate constraint, what's known as the impossible triangle of crypto.
The idea that you can only successfully get 2 out of 3 competing values: decentralization, security meaning investor protection and stability, and mass adoption.
Luna is the perfect example of this trade-off. It tried to achieve high decentralization and rapid mass adoption through that insane 20% APY on Anchor.
But it completely sacrificed security, and that led to the catastrophic failure we just talked about. It proved the triangle is real.
And now we see the future splitting into these really clear paths because of this reality. On one side, you have CeFi centralized finance. This is your major exchanges like Coinbase or regulated digital asset custodians.
These platforms have pretty much sacrificed decentralization. They're audited, they're compliant, they enforce KYC and AML, and they are fully integrated into the traditional banking system.
They've chosen security and mass adoption as their priorities. They're appealing to institutions and, nervous retail investors.
And then you have the true believers, the core code is law idealists, the decentralized purists.
And that ecosystem is splitting, too. You've got permission DeFi, which is trying to appeal to institutional money, but requiring KYC and whitelisting just to get into the protocol.
So it's a compromise. It's still using decentralized tech, but with centralized access control.
And then there's what some are calling dark DeFi. This is the true, fully anonymous, censorship-resistant frontier. These are the protocols operating completely outside all legal parameters.
Prioritizing absolute freedom and privacy at the cost of any legal protection or safety net.
Right. They're being pushed to the legal margins and are potentially seen as illegal by major governments. This is the only place the pure ideal of decentralization really still exists.
The big takeaway here is that the market itself, through things like LNA and FTX, prove that the unregulated utopian ideal is just too fragile for real-world finance. When money is on the line, people demand accountability. And that forces the very regulation the movement was trying to avoid.
Which brings us perfectly from the technical failure of an algorithm in LNA to a spectacular failure of governance, transparency, and political hype. The Trump family crypto company, World Liberty Financial, or WLF.
This is where high-stakes politics and crypto volatility just collided in the most public and chaotic way possible.
This whole story is a masterclass in how political celebrity can just amplify financial risk. It allows these huge valuations to be built on an extremely shaky foundation, and it distracts everyone from fundamental regulatory red flags.
And the story really starts with how they went public, which wasn't the traditional, long, highly scrutinized IPO route.
No, they used what's called a SPAC-like maneuver. Now, a SPAC, for anyone who's not deep into finance, is a special purpose acquisition company.
It's basically a shell company that's already listed on a stock exchange specifically to go out and buy a private company to take it public quickly. It bypasses some of the traditional regulatory hurdles.
And in this case, WLF merged with a small existing publicly traded Canadian company called Alt5 Sigma, or ALTS.
The announcement itself was pure high drama. In August of 2025, Eric Trump and Donald Trump Jr. announced the NASDAQ listing in Times Square with this huge fanfare.
Oh yeah, they were claiming a massive $1.5 billion valuation and proclaiming it would change finance forever. They were appealing directly to their political base, which attracted massive retail interest.
But the media immediately seized on a really ominous detail from that ceremony.
Yes, the NASDAQ bell-ringing ceremony, which is supposed to be this huge celebratory moment for a new public company, was described by Bloomberg and others as a wedding without the bride.
Meaning?
None of the major Alt5 Sigma executives, the CEO, the CFO, the entire team, they weren't on the podium with the Trumps. They only participated through this, disjointed live stream from Canada.
And that absence was a perfect metaphor, wasn't it? You have this high-profile political hype covering for an extremely shaky, questionable financial structure and a completely absent governance structure.
The red flags were raised immediately about how serious the due diligence process could have possibly been.
So let's unpack that financial architecture, the paper-for-paper genius, as some analysts sarcastically called it. This is really key to understanding that inflated valuation.
Okay, so Alt5 Sigma, the shell company, it issued $750 million in new stock. It then used that stock to acquire WLF's WLFI digital tokens, which were also conveniently valued at $750 million.
So basically, the shell company printed shares to buy the Trump family's newly printed digital tokens, and that's how they got to a $1.5 billion valuation through a circular exchange.
Exactly. No actual cash changed hands initially, which is highly unusual for a major public listing.
And this specific deal gave the Trump family about 60% control of the new public company.
Financial critics immediately called it a circular transaction, and they emphasized that the primary function was to use this public vehicle, Alt5, as a rapid liquidity exit for the Trump family.
A way to turn their crypto assets into regulated securities that could eventually be sold to the public.
It was a fast track to financialization without the necessary market scrutiny.
And the market reacted with extreme volatility. The initial political excitement was high, but the collapse was almost immediate. The stock listed around $8.42.
And within 3 months, it had plummeted by 80%. The latest reports cite a 78% drop. And the WLFI token itself dropped by 50%.
That $1.5 billion valuation was a complete mirage. It was built on political excitement, not fundamentals.
And the internal chaos completely mirrored the stock collapse, what we call the Great Cleanout. The rapid executive turnover just showed how quickly the whole foundation crumbled.
Within weeks, Eric Trump had to step down from the board to an observer role. This was a direct result of NASDAQ's independence rules.
Right, which require a certain number of board members to be truly independent of the company's management or founders. It was already a sign of sloppy governance.
Then the real drama began in the Alt-5 Sigma leadership. Alt-5 CEO Peter Tassiopoulos was suspended.
But the internal action happened in September, and the public announcement was delayed until October 22nd.
A 6-week delay in announcing the suspension of your CEO right after a public listing. That is a monumental breach of disclosure and corporate governance. It points to severe internal rot.
And that was just the appetizer. A massive C-suite purge followed in November. It resulted in the company going through a staggering 3 different CEOs in just a month and a half.
3 CEOs in 6 weeks. I mean, just imagine the chaos and confusion inside that company.
The internal investigation notes, which later leaked, were ominous. They warned employees to anticipate litigation and regulatory investigation.
That tells you everything you need to know about the company's legal footing at that time.
But the stock collapse and the executive chaos, those were just symptoms. The ultimate cause, the fatal secret that accelerated the company's demise, was a money laundering conviction that was either hidden or willfully ignored during the IPO process.
This is the ticking time bomb in the whole story. The collapse accelerated when it was revealed that Alt-5 Sigma's Canadian subsidiary had been convicted of serious money laundering charges in a Rwanda court.
And this was back in May of 2025.
May 2025. That is 3 full months before the massive NASDAQ listing ceremony in August. This was a material fact that absolutely should have been prominently disclosed to any potential investor.
The details of the case were shocking. It involved $3.5 million in fines and the use of 52 shell companies for funds layering. I mean, classic textbook money laundering techniques.
And a high-ranking Alt-5 executive was even sentenced to prison in connection with the case.
So this massive material fact, a criminal conviction of a core subsidiary, was hidden or ignored during the due diligence for a $1.5 billion IPO. That is a direct, severe violation of securities law.
The official WLF defense was basically the Rashomon defense. Everyone had a different story, and nobody took responsibility.
Right. WLF officially claimed ignorance. They said they only learned about the conviction after the deal was already closed.
But internal documents show that the related legal files were put in the due diligence data room, which WLF lawyers and executives should have looked at before the merger.
And former employees suggested that the WLF team either intentionally ignored this information or concealed it. A clear failure to disclose criminal liabilities, which led to intense scrutiny from regulators.
This really highlights the extreme risk of what they call the shadow banking risk associated with Alt-5 Sigma.
The Bloomberg report on this framed it perfectly. It revealed that Alt-5 subsidiaries had transferred over $100 million in unknown, often untraceable funds between 2020 and 2023.
And this reinforced the image of a company with extremely lax oversight and a long history of questionable transactions. It linked this high-profile political crypto venture directly to the broader problem of illicit finance that regulators are desperate to stamp out.
It's the Illuminae lesson, but applied to governance. The desire for fast, unregulated success leads to these leveraged systems that just collapse under the weight of necessary compliance.
And given the Trump name attached to this, the political and regulatory fallout was immediate and predictable. It became an instant political weapon for opponents.
It did. Senator Elizabeth Warren, who's a well-known critic of unregulated crypto, she immediately called for an SEC investigation. And crucially, she framed the scandal not just as a financial loss for investors, but as a national security risk.
And that's because of the money laundering taint, right?
Exactly. The worry is that if oversight and KYC protocols were this lax in a company run by politically exposed people, the WLAFI tokens, or their financial services, could potentially be sold to sanctioned entities, like in Russia or Iran or North Korea.
Which would effectively create a financial loophole to bypass U.S. sanctions. That elevates the issue way beyond simple corporate fraud.
And how did this scandal impact Donald Trump himself, even though he wasn't directly managing the day-to-day?
Well, the impact is substantial, both reputationally and legally, even if it's indirect. The scandal hasn't directly implicated the president in any criminal activity, but it has definitely magnified his political and legal risks through the chaotic actions of his family and associates.
The most immediate impact was on his political base. Maggier supporters who invested based on all the political hype and then lost 80% of their money felt genuinely betrayed.
Right. The whole thing was marketed as a victory over Wall Street elites and bureaucracy, but it turned into this massive centralized financial loss for his core retail base.
And the legal pressure is mounting. The SEC and FINRA, the Financial Industry Regulatory Authority, are intensely focused on two key areas. The disclosure violations, so who knew about the Rwanda conviction and when, and potential insider trading during that massive stock collapse.
And while we are highly unlikely to see immediate impeachment proceedings from this specific scandal, the House Financial Services Committee is already planning hearings for 2026.
This scandal provides a powerful counter-narrative to Trump's image as an economic savior. It reinforces the perception that his family's business dealings prioritize speculative profit and extreme risk over sound, ethical financial practice.
It ties right back to the need for accountability that decentralization enthusiasts often try to skip.
So we've gone through the technical collapse of Lune, the philosophical battle between code and state regulation, and the political failure of the WLF IPO and its money laundering cover-up. What is the fundamental underlying thread connecting all three of these powerful narratives?
You know, the common thread is the inherent and, I think, inescapable demand for human trust. We started this whole thing with the promise of trustless systems where math or code or celebrity hype was supposed to replace flawed human governance.
But when that highly leveraged system fails, like Lune's algorithm did, or when it's abused, like using a public crypto vehicle to hide a criminal money laundering conviction, the immediate, universal demand from the public is always for human trust and government intervention.
It is the ultimate paradox of this entire movement. The market proved that trustless systems are inherently fragile under stress.
Absolutely. And we are watching the future of finance split right now because of these failures. On one side, we have the lesson of El Lune applied, a highly regulated, secure digital asset market for mainstream adoption. That's the CeFi path.
Where decentralization is sacrificed for safety and compliance.
And on the other, the lessons from the Alt-5 Sigma scandal and the core crypto philosophy. The push towards a true dark DeFi for those who prioritize absolute freedom, financial sovereignty, and censorship resistance.
But they have to accept the massive cost of operating outside of any legal protection or safety nets.
The lesson for every learner out there, every sip-and-talker, is that the risk of a high-return, seemingly free system is always hidden in the fine print. Or in Lune's case, it's hidden in the infinite loop of the smart contract that leads to hyperinflation.
You must always, always understand the source of your yield and the stability mechanism that's supporting your assets.
And in the political sphere, the shine of a major IPO, hyped by powerful political figures, it just cannot hide the stench of a money laundering conviction for long. Transparency and fundamental compliance are not optional in public markets, no matter how popular or politically energized the vehicle might be. Governance matters just as much as code.
This whole discussion really raises a profound final question for you to consider as you go about your day. If the primary stated goal of crypto was to remove the need for trust in fallible human government, but every single major financial failure in the space, a Lune, FTX, and now this WLF Alt-5 Sigma crash, results in the public demanding more government intervention to protect them, is the original anti-establishment dream inherently doomed to just become part of the very establishment it sought to overthrow?
Is decentralization simply too inefficient or maybe too dangerous to scale to a multi-trillion-dollar financial system? Something powerful to chew on.
That's a thought that ties everything together. Think about that next time you look at the price of Bitcoin.
Thank you for joining us for this Sip and Talk. We hope this gave you a clearer picture of the volatile intersection of code, money, and politics.
Remember to subscribe to Sip and Talk, and make sure to check out our old pal Mickey's YouTube channel, Mickytolife, for fun memes and his latest travel vlogs. We'll catch you next time.